There's lots of news about interest rates, our property market, wages. So this week in our Property Insider video, Dr. Andrew Wilson and I explain to you one factor that's really important to keep track of that's going to make a big difference to when the Reserve Bank raises interest rates. If you want to keep up to date with what's happening to our property markets, please subscribe to our YouTube channel and click the little bell icon to keep informed each time a new show comes out. Moving forward, there's one factor you should watch carefully because it's going to affect many things, including interest rates and our housing markets, and that's the job markets and what happens to wages. And this isn't critical only to those 13.2 million Australians who've got a job, even though they're going to be concerned that their wages keep up with inflation or do better than inflation, but it's what the Reserve Bank of Australia is going to be watching carefully, because they're not going to touch interest rates until wages start increasing steadily and consistently. Now, last week, the Australian Bureau of Statistics suggested the official jobless rate was 4.2%, the same as December, and the lowest it's been in decades. However, I see this figure of 4.2% misses a whole lot of unemployment. Now, sure, in some industries, particularly the hospitality industry, there are critical job shortages. But COVID's complicated matters because over the last couple of months a considerable number of workers haven't been working. Some had COVID while others were isolating trying to avoid having COVID. But now the Australian Bureau of Statistics says that there are only 580,000 jobless in January. That's that 4.2%. But the Australian Bureau of Statistics included 214,000 Australians working 0 hours for economic reasons, presumably because they were stood down because of COVID restrictions. And they included those who had jobs, and then there was a further 450,000 Australians who worked 0 hours because of illness, injury, sick leave, in many cases COVID-related again, and they were also classed as employed. So in my mind, the real jobless rate would be higher. So what's happening to employment, what's happening to our jobs market, and how is this going to affect our economy and our property markets? There's some of the questions I'm going to ask Dr. Andrew Wilson, Australia's leading housing economist and chief economist of My Housing Market. Hi, Andrew.
Yes, good morning, Michael. And yes, you're spot on with those insights into the data out last week. And perhaps, look, the headline number is very positive, 4.2%, as you mentioned, the lowest since 2008, and we should celebrate that given what we've come through. But there are other factors that we need to look at and really understand that our labour market is not out of the woods yet, and that particularly given the prospect of wages growth, I don't think we're anywhere near a normalisation of our economy and our labour market to substantiate the longer term increase in wages that the Reserve Bank is looking for when it pushes the go signal for higher interest rates. And I still think we're some way off from that point. But I guess all will be revealed in terms of the first segment of that phase this week, Michael, when we do get the official wages data released for the December quarter. But just moving back to your insights into the labour market, yes, the headline rate is very positive. But as you mentioned, we had a steep fall in hours worked. Of course, that was from people taking either holiday pay or sick pay, and there were very high levels of declines in hours worked, seasonally adjusted for that month, January obviously being a holiday month anyway. And that did reflect, of course, people taking time off from work to recover or to isolate from the COVID illness. The other point is participation rates fell slightly in New South Wales and Victoria. And that also at the margin flattered the unemployment rates there because we were taking a snapshot of a smaller workforce in terms of participation rates. And I think that going forward, what this means is that we're still not normalising our labour market in terms of providing the underlying, I guess, tension for wages increases. And these are certainly not the circumstances that we would consider to see wages increases. That the Reserve Bank has clearly said that they're looking for a consistent higher level of wages, 3% plus, which was back to the good old days when we did have higher inflation and higher wages and higher living standards going forward. Prosperity is the key word there. But I think we're some way off from that. Even with that headline rate being positive for unemployment, there are still factors that we need to consider that reveal that the labour market is not normalised yet, has some way to go. Both New South Wales and Victoria are around 2% lower in terms of their participation rate than their highs of last year. So there's still people not engaged in the workforce at that same level as we had at their peaks last year. So they're yet to come back into the workforce. And of course, talking of workforce, Michael, I've got some interesting insights into that. If we look at how the workforce in real terms has shrunk over the last 2 years. If we look at the growth in the Australian workforce between 2018 and 2020, we saw it increase by well over 3% and well over 500,000 additions to the workforce over that 2-year period. If we look at the current 2-year period, that's 2020 to 2022, January to January over those 2 years, of course, when we were hit by the COVID issues, we can see that by comparison, our workforce has hardly grown at all, up by just 0.7% and an increase of just 80,000. So 80,000 the last 2 years versus 500,000 the 2 years prior to that, an increase of over 3% in that period and an increase of under 1%. So, of course, that reflects the lack of migration with our closed borders impacting the size of our workforce. And we know that migration is now set to be up and running again. So it's one of those supply side issues, the supply of labour through migration, that has impacted our economy and has perhaps flattered our unemployment rate going forward. But that will change now with borders opening and we're back to migration and growth. And of course, all these circumstances are not the environment you would expect to see an increase in wages through competition for available jobs. So I think we've got some way to go before we get those consistent 3% plus increases in the wages index that the Reserve Bank has signalled. And even if we look at, we're at 2.2% now, Michael. If we look back at the historical increases in the annualised growth of the wage index, and we take out the record level of growth we've had from quarter to quarter was 0.8%. And that was a bounce back through the stimulus in 2010, a bounce back from the GFC period where wages fell, we had the stimulus and then wages picked up. So it was just a recalibration after a significant downturn. And prior to that, the sharpest increases quarterly were 0.4%. And that's what we've seen in annualised growth in recovery from our current COVID environment, which now seems to have stabilised. So to get to 3%, Michael, from 2.2%, we're going to have to record a record bounce back in wages going forward. And I can't see that happening, given that we've already had our bounce back from the decline in wages 18 months ago. And going forward, we still have issues that will be constraining to wages increase, as we discussed before, in terms of participation rates, increased supply from migration. I know that's a bit of a long-winded response, Michael, but I hope that covers everything.
Well, just to make it clear, the Reserve Bank is only going to raise interest rates to slow inflation when wages go up, because the economy won't be able to sustain its upward trajectory until wages grow. That's going to, on its own, slow things down, isn't it?
That's right. And the point is there's a significant lag between demand for workers, an undersupply of workers, and an increase in wages. It takes some time for those low unemployment rates, all things being equal. That's a high participation rate, a low unemployment rate, and a workforce that's growing steadily. And it takes some time for that to work its way into higher wages. So those that are predicting higher interest rates as soon as May, anyway, all will be revealed this week, and we can discuss it next week.
Now, turning our attention to the property markets, we're now back into the swing of things again. Vendors are wanting to put their properties on the market, probably reading a bit that the market growth has peaked, so there's lots more properties on the market. Buyers seem to have more choice. This has affected asking prices, sales, auction clearance rates. So what's happening with the number of properties available for sale at the moment?
Well, Michael, we had a Another big weekend of auction listings at the weekend. The snapshot of the results was another strong Saturday for auction numbers.
Andrew, sorry to interrupt, but if you read the media, you wouldn't believe that, because they're saying this auction clearance rates in the 70s, not the 80s anymore. That was an aberration last year. This is pretty good going, isn't it?
Absolutely. I think that history tells us, Michael, that any market above 65% is a seller's market, where there's upward pressure on prices. We have near 80% clearance rates still in Melbourne and Sydney, and those clearance rates are the highest since last October. Let's remember, at the end of the year, we did see auction clearance rates in Melbourne and Sydney working their way back into the mid-60s. A lot of that was to do with supply and the satisfaction of pent-up demand. But those two markets have bounced back strongly, and those results are clearly in favour of sellers. Now, I don't think we're going to get the sort of prices growth, in fact, I'm sure of it, that we had last year as a result of still high clearance rates. And that's just a factor, affordability, that we've reached our affordability ceilings. We can't keep pushing prices up by the astronomical levels of last year, because the bank's not going to let us borrow anymore, because we're at our maximums, particularly in Melbourne and Sydney, where we've had the strongest prices growth. But that doesn't mean that buyers and sellers are still not active in the market. They clearly are. To say 70% or 75% is a disappointment because it's not 80% is just cloud cuckoo land stuff. And look, we get a lot of nonsense in terms of commentary on the housing market, and all we have to do is look back to all the changed opinions and forecasts that are almost on a daily basis now. But certainly the markets have shown no sign of slippage, significant slippage this year. In fact, those smaller markets of Canberra, Adelaide and Brisbane are still firing on all cylinders at the moment. And it's still a very positive market for sellers, but we're not going to see in Melbourne and Sydney, at least, the sort of prices growth that we had last year, because affordability barriers just don't allow that to happen. But it doesn't mean that we're not getting significantly higher turnover in terms of listings and sales in those marketplaces.
So what's happening with the number of properties coming onto the market at the moment, Andrew?
We've seen nationally the number of listings over the first 4 weeks of the season, and that's up until this Saturday. National listings are up by nearly 30% compared to the same period last year. Sydney up 23%. Brisbane and Adelaide have hosting the unprecedented numbers of auctions this year so far. Both Adelaide and Brisbane are up nearly 150% compared to the same time last year, and Canberra's up around 80%. So those smaller markets are really continuing to boom at the moment. Melbourne new auction listings over the first 4 weekends of this year compared to the same period last year are actually down by 1.3%. But we still have some very big weekends coming up from Melbourne leading up to the Labor Day long weekend, and that's our first Super Saturday of the year. Those auction listing numbers are pointing to certainly continued confidence from sellers in the marketplace. And when we look at overall listings, not just auction listings, Michael, we can see new listings are up nationally by 5.7% to the year to date compared to the same period last year. When we look at the total number of listings, and that's not new listings, that total properties on the market, over the past year, we've seen an increase in listings in Sydney of 13.1%. So that's the number of properties listed for sale at the moment in total. Melbourne up 1.5%. But it's interesting, speaking about the Adelaide and Brisbane markets, Michael, the number of properties for sale at the moment is 30% lower in Brisbane and Adelaide compared to the same period last year. So what that's showing us is that there's fewer properties for sale because of that level of sales activity compared to last year in Adelaide and Brisbane. And again, reinforces the strength of that market and why prices are rising, because buyers have fewer properties to select from. So there's more competition for available stock. And that means obviously an increase in prices growth. And the reason there's still upside to prices in Adelaide and Brisbane, Michael, is because their affordability levels are a lot higher, more affordable compared to Melbourne and Sydney. They haven't had the same prices growth over the past year, but they're sort of in catch-up mode now.
Well, it sounds like the buyers and sellers aren't paying attention to the media headlines. They're not worried about a property market crash. They're not worried about interest rates. They're just wanting to get on with their lives, move home, get a nicer home. And that's good news for our property markets, Andrew.
Yeah, Michael. And of course, what we have is the confirmation of, even though it's not a perfect environment in terms of our economy and our labour market, as we've discussed, it's still a low unemployment number. It's a good market if you're a job seeker. With the COVID restrictions now falling almost across the board, this is something that will add to confidence in buyers and sellers going forward. So, of course, they're more positive about that. And people would have still postponed their decisions last year as a result of COVID and the economy. And maybe we're still seeing some activation of those postponed buyer and seller decisions into this year. But certainly these are strong results for our auction markets, Michael, in anybody's language. No, they're not boom time, over 80%, but gee, they're pretty close to it at the moment. And I expect those clearance rates will likely start to ease downwards into the lower 70% mark, but that's just the market normalising itself. But like I said, if we do get the surge in migration that we've had before, that will refuel housing markets going forward. It's just logic, really. If we get 200,000 extra people into the country this year, then they've got to live somewhere, Michael.
Well, the economists are suggesting that we should bring even more than that into Australia. So it'll be interesting. It'll also be interesting to see the wages data this week.
Yes.
So I look forward to catching up with you next week and discussing that.
Yeah, thanks, Michael.